Okay, hey everyone. My name's PK, and here I've got Emmanuel from AH Jackson. He's a partner at that firm. In this video, we're going to go through tax and accounting. Like, I know it's kind of boring for some people, but for Emmanuel and myself, it's completely not boring because this is a game changer to save tax, to protect your assets, and just structure things properly for property investors. So if you're an established property investor, or you're a brand new property investor, these kinds of conversations, these kinds of strategy discussions should come even before selecting suburbs. All right, this is preliminary. So the next 10, 15 minutes will be, putting pressure here on Emmanuel. He'll be dropping some value bombs. So make sure you stick around till the end. But without sort of further ado, Emmanuel, thank you. I'm very grateful to obviously for you to make the time.
No worries. Thank you for having me, PK. It's a pleasure.
And I should also just add, Emmanuel, I've worked with a bit now, and he's not sort of just some run of the mill. He probably won't be like me saying this. He's not sort of just some run of the mill accountant. He's kind of top shelf sort of stuff. So it's actually this kind of content. It's pretty honourable, and I'm very grateful for you.
No problems. No, we try and think a little bit different. That's all.
Yeah. Creativity is the art of the game in tax. But I think first question, if we just kind of we get into it, like the question that I get asked the most is like, even just at a high level, why is considering which entity structure to buy in, why is that critical? Like, why is that even important? Isn't suburb selection and all that other stuff more important? But what's in this?
I guess from a really high level point of view, I mean, there are some savings that you can have with one is land tax. So if you have all your eggs in one basket, eventually you run out of room for land tax, and the state government will start hitting you with an additional tax, which is not a great thing. It just costs money, and you shouldn't have to pay extra money for that sort of stuff. From a high level also, depending upon your risk profile, it might be worthwhile to protect your assets within a trust structure. In certain circumstances, it works, others it doesn't. And then third of all, ultimately with a trust, especially discretionary trusts, positively geared properties, you've got excess income, which means they need to be distributed. The profits need to be distributed. So if you have a choice as to where to distribute the profits to versus being stuck with an individual ownership, then obviously you could potentially mitigate some tax exposure and cheapen your overall burden of tax. They're your main sort of three critical points that you need. But that being said, asset protection isn't always, it's not 100% protected because your seed capital is also important in a trust, okay? Because it would be in as a loan, and that's still an asset of yours. So you may unwittingly, unravel your asset protection by not doing it properly, okay?
Yeah, gotcha. And, like certainly when I was started in property investing, people talk about buying in your own name. They say that's the simplest way, which is true. Then some people say to buy in a trust. You've just touched on that. And then there were some fancy companies that were talking about hybrid trusts. And then some people were telling me to buy in company structure because that's what they had done in the US and, or overseas. And they'd said, always invest in a company structure. So obviously none of this is personal advice, but like, you've kind of touched on the key tenets, but like, for someone who doesn't know anything, what are the sort of key pros and cons of buying in your personal name versus a trust versus a company?
Yeah. So usually it centers around, obviously, an individual in a trust can achieve what they call the CGT discount on the sale of the property, okay? Whereas a company doesn't get that. So by that I mean any capital gain on the sale of a property, you get half of it tax-free if you own it in an individual name or a trust, okay? Whereas a company, you don't. You just, whatever the profit is, you pay a flat 30%, and then it's in the company, and to get it out, you have to pay dividends down. So the profits come out via dividends, which means if your personal income rate is high, you actually pay a higher rate of tax overall. Now, that's not saying companies are not good entities to have. To hold property, it just depends on your overall structure, because sometimes when you get to a certain level, companies, you can invest in property because you save some what we call top-up tax. If you're in business, you get to save it on one side, so you get more money to be able to use as deposits. But ordinary, sort of people that don't have elaborate structures, we usually head towards holding appreciating assets within, an individual or a trust structure, just because you achieve the CGT discount. Okay.
Yeah, gotcha. And I think one thing I just wanted to touch on, like, all over the internet, you see people, I shouldn't say people, companies advertising that you should buy an investment property to save tax. You buy, everyone's heard of that, right? You're smiling, so I know we're on the same page on this, right? Brand new house land package or whatever it is out in the sticks, and it's, huge depreciation benefit. And someone unwittingly or unknowingly from Sydney, Melbourne, let's say, buys in Brisbane, out in the fringe areas, brand new place, because they've been sold, the fact that they're going to be able to save lots of tax. And for them, they're on the highest tax bracket, making 200 plus K a year. And they're like, well, no brainer, right? Like, let's save some tax. Like, in my mind, it never makes sense to lose $1 to get 50 cents back. But like, what's been your experience with that? Is that something that you think is just a terrible strategy, or could it work? Or, I know that, do you have to pay some of that depreciation back to the ATO if you sell it? Could you, in the future, could you just kind of cover that, Emmanuel?
Yeah, look, I agree with you, PK, that to hand over $1 in cash, especially cash, to get 50 cents back, seems silly, because the property price has to obviously go up in value by at least that amount every year that you own it to break even, let alone account for winning. Okay. Now, the depreciation deductions that you're talking about, it's usually in your purchase price. So you've outlaid it, it's borrowed, you get these depreciation deductions. But so the depreciation parts are okay. It's your capital works, they call it. So to do with the building costs. So basically what happens is they need to get added back to the calculation of your capital gains, overall capital gains tax. So even though you get the deduction, the taxman claws some back upon the sale of the property as well. So it's not all tax free unless you own the property pre the rules coming in, which, for most people today, it's not going to be applicable. So there is a clawback provision within the tax law as well. So I agree with you 100%, PK. It's still got to be a sound investment choice, rather than doing anything for a tax deduction. That just doesn't make sense to me.
Yeah. So is it a fair summation then to say, let's say you bought a property and there's $10,000 of capital works depreciation per annum. So, you hold that thing for 10 years. Obviously, that improves your cash flow, saves tax in those 10 years.
Yep.
But 10,000 per year times 10 years, 100,000. When you sell that 100,000 gets added to any capital gains. And so therefore you have to pay your marginal tax rate at that.
Correct.
Cool.
Correct. Yep. Cool. So it does, it claws it back that way. So it takes it away, essentially takes it away from your cost base. So
right. So short-term benefit, long-term pain sort of thing.
Yep. It's still got to make sense from an investment choice. That's how I always look at it.
Yeah. No, that makes sense. And maybe like a little bit of an intricate question, if you don't mind.
Yeah.
For business owners, a whole bunch of property investors are business owners. And I see on forums and barbecue talks, people throw around terms like bucket companies and, which before starting working, when we started having discussions, I fully didn't recognize the importance of myself, if I'm telling you the truth. For business owners who are buying investment properties and a little bit more sophisticated, how should they structure things? Obviously just general advice, but maybe personal name isn't the best, maybe in a company or maybe in a trust is better. And how does like the bucket company, how does that sort of help?
Yeah, so I guess bucket companies are like I call them the family bank for the group. So usually the trust a trust within a family group will feed profits into a bucket company. So everyone else, what it means is everyone else's taxable income has been maximized up to potentially, up to the top of the 2.5 or top of the 37% bracket. And we don't want to pay higher rate. So we say, look, we don't want to pay that rate. We'd rather pay a corporate tax rate. So therefore, the trust will distribute to the bucket company. Rules have been in place now that the ATO wants you to push the cash into these bucket companies. So as long as you do that, you don't have to comply with other more complex rules under the Division 7A regime. So once this money is in there, though, you've got to still decide what to do with it. So this is where I talked about earlier, where sometimes, it might make sense to go, well, I've only paid a 30% tax rate. I'm going to buy properties in companies because I don't want to pay any further. That was the whole point of distributing to the company. You don't want to pay that, what we call top-up tax. So you go, well, look, and as the numbers get bigger, so if you're talking about $1 million, there's a sort of a bigger tax saving to be had by achieving a 30% tax rate, and they can be used then for your deposit. So that means you have to borrow less going forward. Or you can spread it out over a number of opportunities, and you say, well, look, I'm going to give away the CGT discount. I know that, but if you're an accumulator of property, then I'm not selling, so CGT isn't really that big a deal for me. And you get to keep that extra tax that would ordinarily have gone to the taxman to help purchase more properties and take advantage of opportunities as they come up. So that's the good way that bucket companies are used. They're not just a tax minimization strategy. They can be used to help fund and grow wealth as well if used properly. Okay.
So the bucket company, by distributing income and having the bucket company as one of your beneficiaries, you can pay that 30% tax and then invest from that bucket company into other properties.
Yep.
And as long as you're not using it for personal consumption, you've never had to pay
the top up. So if you utilize it, so from company to company, you're outside the Division 7A rules. But if you take the money from that bucket company and purchase a property in a trust, then you fall back into the rules, okay, of Division 7A, which means you have to make minimum repayments, and it might, and it's over a shorter period of time, over 7 years, so it does place some cash flow strain on repayment cycle. So it does get a bit more complex, and everybody's circumstances might be different. But in its pure form, if you just use a bucket company and then acquire investments from there in other corporates, you can kind of delay or but defer paying any top-up tax legitimately. But you cross that off with not having a CGT discount on the sale of the property if you keep using corporates. Okay.
Yeah.
So that's why the use of companies to buy property is sometimes it's more akin to people in business that don't want to pay that top-up tax versus salary and wage earners or people with other circumstances. Okay.
Yeah, I think that's the way I sort of assimilate it in my mind as well. If you're a wage earner, a PAYG, then in most instances, not every instance, but in most instances, it makes more sense to buy in your own name or in let's say a discretionary trust or something like that.
Yep.
And if you do have a business, then that's when it starts to make sense to buy in a corporate and a company and utilize the bucket company.
At least considering it in that fashion anyway.
Right. Yeah. And obviously
it's a bit of a different way of thinking, but you save on one side, but you give away something on the other. So you just got to balance it out. To what's most important.
There's no perfect structure. That's what you always say. So
never ever
making those trade-offs. And so let kind of ask you a question, right? Like, and I'm asking this from the perspective of having people learn from this. What's kind of like the biggest structure fail or mistake that, I don't know, maybe you've made or one of your clients has made that, you were kind of just, when you saw it, you were like, fell off your chair and you're like, oh, that's literally losing thousands or tens of thousands or 100,000. What can people learn from that?
I can tell you, it was one of my good mates, actually. He went to some property, this is years ago, went to some property seminar, then turned up into my office with this brand new trust with a corporate trustee and contract for this property that he just purchased as a result as well. And anyway, I kind of worked through and I went, okay, well, you are a salary and wage earner, you don't have any risk. Well, sorry, I'll come back. I said, why did you do this? He goes, oh, asset protection and tax benefits. And I said, okay, but you didn't ask me about this. And he said, okay, no. I said, well, let's break it down. You're a salary and wage earner and you're going to be forever, because that's and he is still to this day. So I said, your risk of getting sued for what is, he goes, oh, there's none. I said, okay. So that was not a good thing to do it for. I said, this property is negatively geared and you've got massive, these depreciation deductions. So you're in a loss position. And he said, oh, can't I offset them against my personal tax? I said, no, because the loss stays in the trust. So your whole tax benefit is locked. So I said, you've pretty much done it for no good real reason. I said, just out of interest also, how much did you pay for this trust? Because I did, and he said, oh, I think in the day it was $3,000. And I said, okay, because that's a lot of money on top of it. So I said, so that's probably the biggest fail I've ever seen in my entire life from everywhere, because he didn't come and talk to his accountant, who's his friend, first on top of it. So let's just say it was an interesting conversation that we had.
And then there's a maintenance cost, right? Like it's not just $3,000 one off to maintain a trust. And this is the thing, right? And I don't know if you agree, Emmanuel, but try to keep it simple. Like most people should just try to keep their structuring simple. Yes, you should chat to someone like Emmanuel to see if there's something where you can optimize things. But for most people, keeping it simple is the cheapest and most effective way anyway.
And yeah, I'm all for that as well, because there's no point in complicating people's lives for no good reason. There has to be a good reason for why you would structure. Otherwise, there's no point.
Yeah, no, I mean, you're infinitely more experienced than I am in terms of all the structure stuff. But as you know, Emmanuel, our structure is not the simplest anymore. And it to some extent just goes over my head. So yeah, take it from me to keep it simple. Otherwise, you need like a flow map just to kind of, on a whiteboard to just understand
visualize
what's happening with your money, visualize. And that's, for most people, that's not a good place to be.
No, you don't need structures. If you don't need it, like there's no purpose in doing it. And yes, circumstances change, but that's why I think it's important to sort of talk to somebody who understands this stuff. And then, because we'll ask questions usually about, yes, your current circumstances, but what are your kind of your crystal ball a little bit and your intentions going forward, and life changes as well. So, the biggest thing with property is every time you want to change ownership or something like that, stamp duty comes into play, and you don't really want to have that horrible waste of money for nothing. Okay, so that's just something that you should always kind of be mindful of. Have an idea for now, but half an eye on the future a little bit as well. So
right, and I suppose that's where your tax accountant comes into it, having half an eye for the future, asking those questions, at least letting you know what's possible. Like there's an element of people like me, we don't know what we don't know, perhaps, especially if you're brand new. So I think that's where the accountant comes in. And so how, like maybe last question, if you don't mind, Emmanuel, obviously, I highly recommend you from Jackson. But let's say, people aren't interested in working with you. And by the way, I should say, an accountant is a national license, so he doesn't need to be state by state or anything like that. But how does one go about, let's say they don't know anything, how does one go about finding a good accountant, someone that will actually help them?
I always find, even in my own network, word of mouth is still the greatest thing you can have. So if your contacts, people you rely upon or trust, are suggesting someone, at least go and have a talk to them. Have a talk to a couple of people, to be honest, because personality has to come into it as well. Because you could have the greatest accountant, but if you don't like them, you're not going to communicate with them really at the end of the day. And you need to have that interaction, in my mind. But I still think personal connections and personal referrals, or from people you trust, is always a good way to start. Don't believe the advertisements is my view as well. Anyway, that's
Yeah. No, for sure. And that's how I sort of found most of my team as well. So I can totally sort of agree with that. And a bit of a controversial thing that I'll say is like, if an accountant has been around for a while and they need to advertise to get clients, then there's not a blanket rule, but there might be something dodgy with that, because if they're experienced and you're seeing their adverts everywhere and they're kind of in your face, then either they've scaled too much and you're not going to get that personal service, or for some reason they're turning over clients. That's just a kind of a generalization just from my personal experience. But yeah, go with someone a friend of a friend, someone who you can trust. And for me, definitely Emmanuel from Jackson is someone like that. He's based in Brisbane. Obviously, you don't need to use him. You can find someone yourself. But yeah, it's a national license. But thank you. Yeah, first of all, thanks for everything you do for me, and thank you
a pleasure.
for making time. Any last comments or value bombs, as they say, that you want to leave behind?
There's make sure you talk to someone who can help advise you, because the other point that we probably didn't touch on is, make sure you structure your loans correctly to take advantage of interest deductions and things like that as well. So you've got to do it in a particular way to make sure that you get your interest deductions. So that's the other big thing that I see. But just you're best to talk to somebody, get some advice. That way it's done properly, and you can maximize any tax benefits that you can. Okay.
Yeah,
that's what I'd say to you. Yep.
For sure. No, that's a good call out. Offsets versus redraws, and that's a whole thing that we can go into as well. But thank you, Emmanuel, and thanks everyone for watching as well. I hope that sort of gave you value. It's kind of a really deep topic, and you can go, really deep into particular tentacles of it, and it gets really niche real quickly. So I just wanted to leave it at that high level. But if you guys have any questions, feel free to comment below. I'll try to answer them. Otherwise, just reach out to Emmanuel. And yeah, best of luck. Subscribe below, and I wish you all the best with your property investing. Catch you later. Thanks, Emmanuel.
Thanks.